On Point with Craig's Investment Partners.
The information provided here is general in nature and it's not financial advice. It doesn't take into account your situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. Before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services or to view the Craig's Investment Partners financial advice provider disclosure statement, please visit our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Let's talk about inflation and ponder whether 3% is the new 2%. Will inflation run a little hotter in future than we've become accustomed to? Inflation is well down from the multi-decade high of 7.3% that prevailed a few years ago here in New Zealand, but it remains stubbornly above that elusive 2% level. We're not the only ones grappling with stubborn pricing pressures, and there's a growing chorus of commentators that are asking the question about whether something more structural is at play. Here in NZ, inflation has averaged 4.2% over the last 100 years. That was driven up by the extremely high inflation of the 1970s and 1980s. Back then, the Consumer Price Index, the CPI, rose at an annual rate of almost 12% over that 20-year period, and that caused all sorts of problems across our economy. In the US, it was a more modest but still very challenging 6.2% during those 2 decades, which is also well above the 100-year average of 2.9%. Now, that period saw our Reserve Bank, the Reserve Bank of New Zealand, tasked with bringing inflation down, and in 1990, a specific target range of between 0 and 2% was put in place. That initial range was adjusted to 0 to 3% in 1996, and then it was narrowed to 1 to 3% in 2002. That was the first year the Warriors ever made a grand final, and that's where that target range is today. Other central banks around the world followed our lead, and inflation was low and stable for the bulk of the next 30 years, from 1990 right up until just before 2020. In fact, inflation was a little too low in the decade after the GFC, the global financial crisis in 08-09. It averaged 1.6% in New Zealand and 1.8% in the United States. And that was despite policymakers employing a raft of measures to try and increase it. In the US, the Fed funds rate spent 3/4 of the 2010s below 1%. And there was also additional stimulus policies like QE, quantitative easing, that were put in place too. Here in New Zealand, our official cash rate, the OCR, averaged about 2.5%, and it never went above 3.5% at any point over the 2010s. Now, this decade, which happened to coincide with the COVID-19 pandemic in early 2020, this decade has been very different. Our inflation rate has averaged 4.1% these last 6 years, while in the US, it's been 3.9% on average. And both countries have seen it fall from the record highs of 2022-ish, although here in New Zealand, we're still up at 3.1%, and in the US, the inflation rate has been persistently above target, closer to 3 than 2 for a lot of the time. In Australia and in the UK, they have also found it difficult to get back to their targets. Their respective CPIs in those countries have been running above 3%. That last mile back to 2%, which is what most of the central banks are looking for, that last mile is proving much harder than expected. And many of us would argue that deglobalisation, demographics, and the energy transition might entrench that dynamic. Fiscal dominance is another factor, and this would be arguably the most important of all. Fiscal dominance describes a world where government debt levels have become so high that central banks can no longer raise interest rates sharply without causing too much damage to public finances. Now, whether it's here in New Zealand or in the United States or elsewhere, those higher rates would increase the government's interest bill, And then those payments, those interest payments, would flow directly to whoever owns those bonds. It could be households, it could be pension funds, it could be investors. They will get those interest payments as income, and that supports spending as well as economic activity. So because there is so much more debt outstanding today than there was in the past, these flows are large enough to offset some of the cooling effects of higher interest rates. Ironically, what this means is that in some ways, higher interest rates can actually add to inflation rather than completely suppressing it. And this is all because of that higher government debt backdrop. So as a result, a lot of people think that policymakers could become happier to tolerate slightly higher inflation rather than risk destabilising growth or triggering any fiscal issues. Now, if proponents of fiscal dominance are correct, this is creating a structural shift away from the ultra-low inflation environment that defined the decades leading up to the pandemic. Now, you don't have to be a conspiracy theorist to also figure out that highly indebted governments would also benefit from letting inflation run slightly higher. Very conveniently, this would gradually reduce the real value of their borrowings over time. They would inflate away some of that debt, which would put them in a stronger position. Now, if 3% or even 4% was the new 2% when it comes to inflation in the future, this would have important implications for investors. Shares typically perform well against the backdrop of moderate inflation because companies can grow their revenues and their earnings alongside rising prices. But you do need to think about the shares you own. Do those companies have pricing power, and do they have the ability to raise their prices without losing customers? Commodities have also proved a good hedge for investors in the past, while other tangible assets like infrastructure, like high quality real estate, they can also do well when inflation is higher. In contrast, cash in the bank and bonds would have a more challenging time. Their returns are fixed, which means that their purchasing power can be eroded over time. Cash and bonds don't have any growth, so when inflation is going up more than we're expecting, their returns won't keep pace with it, and they do tend to lose their value in inflation-adjusted terms. Now, maybe we need to just give monetary policy a little more time to do its job, or maybe there is a more permanent change in the landscape that is on top of us. Without going overboard, investors might be wise to consider an environment where inflation is indeed a little hotter than we're hoping it will be, and make sure you've got the assets in place that will at least keep pace with inflation. Think about the allocations between growth assets and income assets. Think about some of those insurance policies, infrastructure, commodities, good quality real estate, companies with pricing power. Do you have an exposure to some of those assets? Talk to your advisor if you want to know more. Enjoy your day, team. Thanks for listening. We'll talk again soon.
For more insights, visit craigsip.com.